Connection established.
Hey everyone, hope you're all doing well. In today's video, I'm going to be discussing liquidity, and this is going to be the next video of kind of the Perpetual Futures series I've been doing with content. It's going to be a relatively short video, nothing crazy like the fair value gap one. I'm thinking 20-30 minutes, but it's very important and will allow you to align yourself properly when you're trading. So let's get in. So in my terms, right, what is liquidity? Well, liquidity is where people put their stops, and market makers and exchanges need money to move their orders, right? You can't buy something without someone selling. And so it's areas where there's a lot of orders, either stops or buy orders or sell stops, right? Where there's a lot of cash sitting and market makers have an incentive to drive price to that one area because that's exactly where they're going to be able to fill their orders or exchanges orders or whoever's orders, hedge funds orders, etc. Right? So liquidity is areas where there's going to be buy stops, sell stops, whatever, you name it, to get into or out of the market, and there's an incentive for market makers to drive price there. All right? And now let's just look at a quick definition of this website. Liquidity is the first and arguably the most important concept within the ICT trading methodology. There are two types, buy side and sell side. Buy side represents a level on the chart where short sellers will have their stops positioned. So right here, right? If you're shorting, your stops are going to be up here. Sell side is the opposite. So if you're buying, your stops are going to be right here. It represents a level on the chart where long bias traders will place their stops. In both cases, these levels are found often at near extremes as the tops and bottoms of ranges. Smart money, aka hedge funds, exchanges, market makers, understand this nature and will commonly accumulate or distribute positions near these levels where the stops reside. It is in part the sheer amount of stops at key levels that allows a larger player with more money, right, to get in or out of trades. Once the level at which many stops are placed has been traded through, it's often that price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme, right? So for example, on this example right here, if I'm longing, if I'm buying, where's my stop going to be? If I bought here, my stop's going to be right here. Right? Or at least that's what 99% of retail traders or just traders in general do. I wouldn't put my stop there, but that's where most people do. And so what do? The market makers fake it out. They pull it back. And guess what? If you were buying here, your stop is here. And guess what? They're going to take your sells because you have to sell it. If you were longing here, you have to sell it here. And guess what? For someone to sell, a different person has to buy. And then guess what? All the exchanges here just keep buying, and then they send price up here. And likewise, on the same time frame, and same example, if you're short, your stop shouldn't be here, but most people put their stop here, and they're going to do the same thing. Well, they bought, they have to sell. Well, if you're selling, you want to be buying, right? If a person shorted here, they're going to have a buy stop, right? Because a short is a -1 position, meaning to cancel out the position, they need to do a +1, buy it back, right? So they're going to have millions of +1 buy orders here, and guess what? They bought here. Well, you're buying, well, they're going to sell it to you. So the exchanges will sell it to you right here, and they're going to stop you out, and they're going to make money and take the profit. And that's all they do. So there's your example of what liquidity is right here. And it's very simple, and it should be the #1 framework that you use in order to be getting in and out of trades, okay? As well as determining bias. So before I get on TradingView and give you more examples, if you do need a perps platform, you have either Axiom or Hyperliquid. Hyperliquid is better, it's cheaper, and you have the airdrop, but as I said, Axiom's powered by Hyperliquid, so you can get either of them with the link in bio. So now let's get into TradingView and discussing more examples. So, for example, daily chart on Bitcoin. Well, what do we see here, right? Let's just zoom back a little bit. Liquidity here. Liquidity here. See how we have so many stacked liquidities? If you were buying here, if you were a buyer, most people, if they're buying in this area, if you're long here, long here, long here, long here, long here, long here, well, where are you going to put your stops? You're going to put your stop below this low or below this low or below these lows. And so the market initially will go in your favor. It usually does. Why? Because it wants people to get overconfident and keep buying. So you're going to keep buying here, buying here, buying here, buying here, buying here. And guess what? Your average is going to creep up and up and up. And then what happens is they're going to do a quick displacement to the downside. And what are they going to target? Well, they're going to target liquidity zones, right? So there's your low with stops right here. Then you have one right here with stops, right? Then you have these ones here. And so what do? In 3 days, they dumped it. They already took out these liquidities. And what are they going to do? Well, the liquidity that often gets targeted, and this is very important right here. This one's very important. So there's certain types of liquidity that gets targeted. So the first high or low into a fair value gap is always targeted. That's a great area to not put your stop, but actually take the opposite trade. And then relative equal highs and lows, right? So what does that mean? Relative equal highs and lows. That means highs and lows that are essentially the same. So like right here, if you guys can see, you have a low right here. Well, what happens? We dump. They form this low right here, which is relatively very close to the same price level. And then they pump it out. And then guess what? They do this again right here, right? So let me move it like this so you can't see the future price action, right? So let's delete these lines, right? So look what they do. So imagine this is all you know, right? Well, they pump it. They create this low here first. This is a lot of sell stops in here. Because if you're buying, people are gonna put their stop right here. Same with here. So you have a stop here, right? Let me draw this one too. You have a stop here. Guess what? It keeps pumping. People are gonna put their stops here, right? And then what do? They dump it. They take out this first level of liquidity. Then what do? They create this level of relativity, relative equal lows. They're relatively equal, right? So the exchange, well, not the exchange, but the market makers are baiting people into longing because they dump it about a couple points out of here, out of this price level, and they pump it up here, and everyone that's long and had their stops here is like, oh, we're safe. It's such a strong move. We pumped. Well, guess what? They're going to do it again. They fake you out again, then they pump it again. Right? They take out this liquidity right here. You see that? So this is low, high. See, they take out this liquidity of people going short. Because, for example, let's go into a little lower time frame. Let's go into 1 hour. So look what happens, right? We're on the 1 hour. So you have this liquidity zone, this liquidity zone, this liquidity zone. They dump it. Look how close it got. They fake you out. They pump it. They look at this fair value gap right there. Right? Then guess what? They dump it again. Look how close it got. Once again, they're building this liquidity. So everyone that's longing is putting their stops right here because they're like, ooh, it's a triple bottom. It's super strong. No, false. What do? They pump it up real quick, take out this liquidity. What do? Remember when I said the first high or low into a fair value gap is great liquidity? Well, look at that. Look at that. Don't you see it right there? There's your fair value gap. That's your first high. Well, look what happens. There's your second high. They take out this liquidity right here. See? So they target it. They stop all these people that are short. Because how I showed you guys, fair value gaps. You want to short fair value gaps. So they do. And they put their stop right here. And they're targeting this low right here. Well, guess what? It didn't hit the low. So they didn't get tapped in. They didn't get filled on their exit, right? Their target profit. Their target profit was right here at these lows. Well, guess what? The market makers are like, nope, we're going to come back, stop you out. They didn't take profit here. They got stopped out, and then they nuke it. And guess what? Then they take out this liquidity right there. All right? And so that's how the market works. They take out either the first high or low into fair value gaps, as shown here, right? This is the first high into the fair value gap. They dump it. They tease you. They don't take out this low. They pump it, stop you out, and then they dump it, and then take out this low, this low, this low. And then what do we get? Well, they take it out right here. Then they pump it again, right? Take out this liquidity. Then they dump it again, right? Take out this liquidity, this last one. So they got liquidity, this liquidity. See how, once again, they built relative equal lows? They're not perfect, guys. But see how close they are? They purposely do that because most people see relative equal lows, relative equal highs, and they're like, ooh, that's so strong, right? It bounced right off. No, that's just them teasing you to put your stops there so they could take you out. So if you're long here, your stops here, you're long here, your stops here, they're going to wick you out. You're going to get stopped out and lose money. They're going to buy it off of you, right? Because if you buy, you have to have a stop that sells. And they want to buy, well, they have to buy from someone. So they're going to buy from you when you're stopped out because you have to sell it. So you're going to sell it cheaper. They're going to wick you out. They're going to buy super cheap here and then they're going to pump it. And look where they target. This price right here, which is another liquidity level right here. And guess what? It dumps. And then they take out this liquidity level, come into here, take out this liquidity level, then dump, right? And then they bounce off this level, and then they chop, and then guess what? They go lower. And you're like, well, Chris, how do you know which liquidity level will go where, blah, blah, blah? Well, it's common sense, right? If you have a high or a low, if we do not close below it, it's not good. So for example, right here, we had this liquidity level, this all-time high. You see how at one point this daily candle was a full green bar. At one point, this candle right here was this big. It was this big, right? At one point, it was that big. It was a big green one to 109K. And what happened? It got fully rejected and closed right here at 102. Well, that means we're reacting poorly off of this level. So what we want to see ideally is a retest of that level and then a pullback. But also another concept you could do is an ICT concept is the wick. See how it trades around the wick. So see, it couldn't really get above the 50% of this wick that took this liquidity. That points to me that it's weak and it's probably going to go lower. Of course, in hindsight, everything works perfectly, but this is what you have to be looking at in real time and not letting your emotions take over you, right? You see on Twitter, a lot of people are like, oh, we're going to 200K, whatever. Yes, we will in the future, but you have to play the present, right? You have to play what's shown to you right now. And so we didn't close above it. We rejected it. So we know that there's a weakness. Well, there's a strength of the resistance level here and a weakness of current price action. So we know we're going to struggle. And so that's how you know if a level is going to work or not, right? So right here, we have these levels right here. See how at one point this candle was a full down candle? At one point, it was this big right here. Well, guess what? It closed right here. It opened right here and it went all the way down to 88 and closed up here. That's bullish because it swept all the liquidity and then it was bought all the way back. Here, I'll draw a circle around this price action and we're going to go investigate it. All right, let me actually delete everything so it's nice and clean. And then look, we're going to investigate this price action. And look, we have the lows right there, right? So let's go into the 1 hour. You see that? You see how we came into this zone, right? Look at all these zones. Stops here, stops here, stops here, stops here, stops here, stops here. It's all stops. Everyone that's buying is putting their stop there. So what do? They manipulate it really quick. And look, this is the V-shaped recovery. If you see on my Twitter, I talk a lot about V-shaped recoveries when it dumps. V-shaped. Because it's a quick dump, it's manipulated to stop everyone out, and then they buy it back. And see how it quickly bounces back? That's what you don't want to see. If you're shorting, if you're a person that's shorting, you do not want to see that. You want to see continuation, right? What you want to see, if you're a shorter, right? You're going short, you want to see something like this, right? Or something at the worst case scenario in here, like this. You don't want to see this. A V-shaped recovery is never good if you're targeting it to go lower or higher in that same direction. If you're short, you want it to go something like this or something like this. You don't want this, okay? You do not want the V, but that's how you know that was a liquidity sweep and it was just a quick manipulation candle, right? To take out these stops and the further stops over here to pump it higher. That's how you know, because it's a V-shaped. And that's why you should be patient. If you're shorting, you should always take partial profits at external or internal liquidity pools. What's external? External is the top or bottom of a range. Internal is the liquidity inside the range, right? So say this is our range. Let me draw it like this. Say this is our range right here, right? And this is our range. Anything like here that's internal liquidity, right? Internal liquidity. This is external because it's external out of the range. It's the top and bottom of the range. So anything internal are going to be your fair value gaps. The first high or low into fair value gaps. Right? If it's a bearish fair value gap right here, it's going to be the high. If it's a bullish one, it's going to be the first low. External is going to be the top or bottom of the range. Okay? And that's how you know. That's how you should orient yourself when trading these perps on swings or daily levels or even day trading, right? And as I mentioned before, I did fair value gaps as the first video. Market makers will target two things only. There's only two things they target. Liquidity, like shown here, right? All of these liquidity pools, or fair value gaps, because fair value gaps is an inefficiency in price. That's all it is. right? It's an inefficiency in price. It means price went in that one direction very fast. And so they want to manipulate it to the opposite direction to fill in those imbalances. All right, so that's all you should be looking at. And that's how you should be determining your bias. Okay, guys? So don't go into a perps trade only looking at Bitcoin like, oh yeah, it looks good. You know, it dumped this much, let me buy. No. Zoom out. Okay, we're in a monthly fair value gap. Okay, we're in a weekly fair value gap. All right, see, we had this liquidity zone. We took it. Now we bounced back into this old fair value gap. Now it's an inversion. We're rejecting it. Okay, so we're still in a bearish downtrend, right? We're still downtrending bearishly. We're making lower lows and lower highs. So until that changes, we're still bearish. Most of our shorts are going to be more profitable than our longs. And that's it. Look at NASDAQ as well, right? See what it's doing. Look at NASDAQ on the daily. It's just making lower lows and lower highs, as you can see right here. Look, that fair value gap right there. Took it, right? Rejected. We have this liquidity they took. They took this liquidity. They're in this fair value gap now, right? This gap, this fair value gap. So maybe they're going to target these lows right here. You don't know. Maybe the market makers on NASDAQ, the CME exchange, Chicago Mercantile Exchange, is going to target this right here, right? And so that means we have another 2,000 full points to go lower. And there's nothing you can do about it, okay? They just maybe want this liquidity, or they want this liquidity, right? And there's nothing we can do. They're going to do whatever they want. You just have to position yourself accordingly, all right? But what you should do is when you're waking up and you're going to trade, look at NASDAQ, look at the S&P 500, look at the overall macro structure of Bitcoin, right? We're on a downtrend. So shorts are going to be more profitable. They're going to go lower and longer than longs. Longs are not going to be as long to the upside. They're not going to be as profitable. And it's going to be a lot tougher price action, right? See how right here it took so long to pump. Meanwhile, this is a quick dump. See the difference? See how it takes four 4-hour candles to go up. Almost 70% of what this one 4-hour candle did. You see that? Because you're trading against the trend. This 4-hour candle went from 87,400 to 83,700. This candle right here opened in 4 hours. It went virtually nowhere. Right? We're looking at the open and close. Same thing here. Another 4 hours, another 4 hours, another 4 hours. So in 16 hours, it did maybe 80% of what this one 4-hour bearish candle did. Because you're trading against the trend. And then look, it nukes. Right? Of course, you're going to get that V-shaped recovery at times. As I mentioned, V-shaped. Because we took out liquidity levels and we bounced off fair value gaps. That's obviously going to happen. But you're still against the trend. See how we pump and then instantly nuke? And then very slow grind, and then we nuke again. And look, again, see how long we've been chopping here? 4 hours, 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 and then boom. In 4 hours, it did what maybe it took 2 days or 3 days to do. Because you're against the trend. The trend's downwards. And how do you know the trend? Fair value gaps and liquidity pools. That's all you need, right? Market makers will only target liquidity or fair value gaps. See, we had this liquidity. They dumped it, right? Pumped it into this fair value gap. Dumped it, pumped it, dumped it, took this liquidity, right? Maybe we have liquidity here and we have this fair value gap in here. Maybe that's what they're targeting right here, right? It's a stacked low into a fair value gap. See how that is a low in a fair value gap? Remember when I said they love to target lows and fair value gaps, right? So maybe they take this liquidity and dump it to 74K to 70K in there. Who knows? But that's how you should be trading. Right, and you could do this on the low time frame, and that's how I personally day trade. Look, all right, 1 minute might not be the cleanest. Let's do 5 minute, right? Well, look at that. At 8:30 this morning, we had core PPI news, okay? And you should know when economic news events are occurring. You should know. And so at 8:30, guess what they did? They manipulated price action higher, right? They manipulated price action higher, took out everyone that's short. If you're short, your stop's here. Well, if you're a bad trader, your stop's here. So let's imagine I'm short. I'm short here, right? My stop is up here. My stop is all the way up here. And I'm say targeting here, right? If I'm shorting, my stop's here. My stop is not going to be right here. Absolutely not. Your stop's going to be right there. Okay, and say I'm targeting this low. See how I'm targeting this liquidity zone, right? I could take a partial here, right? I could take a partial here because you have stacked liquidity right here. See that? So you have liquidity here, liquidity here, liquidity here. So you can take your first take profit like right there. See how we have a liquidity right there as well in the fair value gap. See that? Liquidity is there right there. We have a fair value gap right here and liquidity. See that? Let's drag it across. See what happens. And look what happens. We dump on the 5 minute. We come back in into the fair value gap. Now it's an inversion. We reject the middle line, which is the 50%, which is the most important price level of it, and we dump, right? And now we're bouncing off this rejection block right here, which I'll cover in future videos, but it's essentially the last candle that took the liquidity and is pumping. Some call it a change in state of delivery, whatever, order blocks. It's all the same stuff relatively. And yeah, so as you guys can see, taking liquidity here, fair value gap, liquidity. But what happened? At 8:30 a.m. this morning, New York time, PPI came out, which is it's always the day after CPI. Yesterday was CPI at 8:30. And what happened? They pump it. The market makers manipulate everyone that was short. They stop them out, right? So imagine you are shorting right here. And then they do this. They pump it. At one point, this was a full green bar, right? You're like, oh, dang, I got stopped out. Let me long. I'm going to go long right here. I'm going to go long right here. Because at one point, this was a full green bar, right? At one point, this was a full green bar. It was pumping like this. And you're like, oh, yeah, let me go long. Let me put my stop right here. And let me take profit right here. Well, no, bucko. 8:30 was the manipulation. And they're going to short it. You're going to get stopped out once again because you're wrong. And then they're going to target this area right here, these liquidities and these liquidities. All right? Because that's all they do. They move in tandem with liquidity. 8:30 a.m., if there's an economic news driver, so CPI, PPI, NFP, non-farm payroll, it mainly affects the S&P 500 and NASDAQ, but that directly affects Bitcoin, Solana, and everything as well. For example, yesterday, 8:30 was CPI. Well, look what happened at CPI. Right here. This was a 1 minute candle, by the way. I'm on the 5. Let's go on the 1, right? So yesterday, CPI, 8:30. Look at that. This is 8:30 right here. See how it pumped from 83,000 to 84,400 in 1 minute? Well, why did they do that? To take out this liquidity. You see that? So we're right here, right? We're right here. 8:30 comes out. The news, CPI, oh, it's really good. They pump it. Guess what? Everyone that's short stops right here. They're going to stop them out, and then they're going to dump it. And you're screwed. And see how I said, ideally, after taking a liquidity pool level, you want to see a rejection? Well, look. See how it comes up and then rejects off this level? This is your short right here. This is your short right here. That right there is your short. All right? Right here, you have the level. Okay, right here's your level. Oops. Right there's your level. You are hammering shorts on this rejection right here. You get it? So you let them do whatever they want, manipulate price. The second after it goes above it, takes liquidity and goes below it and then comes in and rejects it, you are hammering shorts. You don't full port, don't do stupid stuff, but that is your bread and butter. If you have a lot of money and you only have the time to trade 4 or 5 times a day, 4 or 5 times a month, just mark out CPI, PPI, NFP, and FOMC on this website I'll show you guys in a second. And I've showed it previously, forexfactory.com. And that's all you have to do is wait for them to take one liquidity level right here and then come back in if they rejected it and just short it or long it depending on how it's reacting, etc. That's all you have to do. It's very simple, right? The market moves in zones of liquidity. That's all they do. See, likewise here. This was CPI high right here. Oh, no, I apologize. This was a previous high right here, right? Liquidity. They take it again. They reject off this because this was a key price level. This was CPI, so they're not going to take the CPI data. And look, they come back in, reject this level once more. So old levels of liquidity get traded with. okay? And here, I didn't even see this, but here's an example. Look, you see this fair value gap right here? I didn't even see it, but look, see this fair value gap right here? What did I say? First tap into a fair value gap usually gets targeted as liquidity. Look at that. There's your high, there's your low, and look where we go. Right? There's your fair value gap. There's your first low liquidity levels. Everyone's going to place their stops right here because it's like, oh, we bounced off the fair value gap. We're good. Well, boom, boom. They tap it, right? It's very minuscule, but they do take it, see? They hit 607. Everyone's stops were 624. So most people, oh, actually, I was wrong here. I apologize, 1 second. They still took it though. You know what I'm saying? But also, guess what? Guess what? This is actually right here now. What do I have that? This is relative equal lows now. See that? See how they're very close to each other? This is a low, this is a low. Well, guess what? They're going to target it right here. Look at that. They're going to target these lows right here. And that's what they're doing. They rejected the level. Now they're dumping. They're going to take out these liquidities. I'm sure of it. Well, I'm not sure of it, but it's very high probability. Very high probability. It's only 600 points lower. It's a very high probability they're going to take these relative equal lows out. Why? Because people that are longing here put their stop here. Then they came in here, it bounced, it didn't take it, or it did, but barely. They're going to put stops here. And now, so a lot of people are going to have stops here and here, and they're incentivized, market makers are incentivized to go down there, right? To push price down there, to stop all these people out, and then fill buy orders to go higher. That's all it is. That's all they do. And so liquidity is very key. And so I want you to always look for it. If you're trying to trade, look at if they took liquidity or if they're already going into a direction of liquidity, right? So like right now, obviously you wouldn't want to short at the lows right here because we already dumped a lot, but you'd be wanting to find, you'd be wanting to find areas where there's liquidity already. So for example, right here, there's a high right there, okay? And so maybe what happens, which I doubt, but it can happen, right? Instead of targeting these lows right here, right now, what they can do is fake it out again. Maybe they do this, come here, take out this liquidity, and then dump it, like the example I showed you earlier. I doubt it personally because it looks very weak, and there's the fair value gap in here, and this liquidity, and of course they have liquidity here and all that smooth stuff. But I wouldn't be surprised. Sometimes they do that. They play games. But genuinely, I think we just plummet through here, through these levels, and dump. But that's how you got to think, right? You cannot short right here. It's stupid. Why? Well, it's a simple concept called discount and premium, which I'll cover in future videos, but you don't want to be shorting in the bottom half of the range, right? You just don't. So, for example, this is the range right here. So you can't be shorting. Like ideally, you'd be shorting above 0.5 or at 0.5. And look at that. You have actually liquidity tongue twister. You have liquidity right there at 82,455. And so I'm not saying they're going to do this. I think personally they take this level. But what they can do, if they really want to, I'm not saying it's going to happen, but they fake it out, come here, take out this liquidity, hit the 50% of the range, right, high to low, and then dump. I don't think that's going to happen. But that's the frameworks and trades you should take. You should not be trading every day. If there's not a good setup, you're not going to trade. And of course, you could zoom out, right? You could go on the 1 minute, right? But the thing is, don't get lost on the 1 minute. Stick to the 3 minute, 5 minute, 15 minute, 1 hour, etc., right? Look at the 1 hour for kind of context. Like what's going on, all right? What's going on here? Oh, I don't know. We look bearish. Okay. And they keep zooming in. Right, 15 minute, we had a fair value gap, yada, yada. Like, look, right here, we had a fair value gap right here, plus an order block. Let's go to the 1 minute. See, we kind of came up, came here, rejected, and then going lower, right? So that's pretty much the video, guys. It's just liquidity. It's very important. The first step of your trading should be in determining your bias is liquidity. What direction are we going in right now? Is it going up? Is it going down? Did we take liquidity, right? Like, for example, right here, did we take, see this high? We took this high right here, right? So we took it. Are we bullish and going higher? Are we going lower, right? We see the rejection off this, then we know we're going lower. Vice versa, right? Price levels and liquidity zones you should mark out. The best way to do it is just draw a line and identify how it trades. As I showed you this example right here, right? I'm gonna show you it again because I want to beat it into your head. We had liquidity here, stops right here. We pump above it. Come down, pump again, come down, reject. Right here, as I mentioned, you're hammering shorts on the rejection of this level. And then you're targeting whatever you want to target. You're scared, you could target this fair value gap right there. You're more confident, you could target these relative lows right here. Low, low, right there in the fair value gap. You're very confident, you could target that low, right? You're very confident, you could target right here, right? In this price level. So it's all based on how you want to trade it, but you need to understand liquidity is what moves the markets. Exchanges use market makers to push price one area or another to buy crypto stocks, NASDAQ, whatever you want at prices that they want to, right? There's a famous saying, you buy at the price you deserve, right? As a trader, you buy at the price you deserve. It's how patient you are and all that. Exchanges, market makers for them, etc., will buy at the price they want. That's just how it works. These algorithms purposely will stop you out if you're too tight or on the wrong side of the trade because, one, that's how exchanges make money, and two, that's how exchanges fill their orders. If, say, Coinbase wants to buy, think about this, guys. If Coinbase wants to buy $5 billion of Bitcoin, right, are they going to buy Bitcoin at 107K or 110K or whatever? No, man. Why would they do that? That's the dumbest thing ever. Why would Coinbase buy $5 billion of Bitcoin at 110K when they can just sell all of the assets and give it to market makers and drive price lower with all the other exchanges who also want to buy stuff cheap and just drive price lower to say 75K. And then they hit 75K and they're like, all right, we'll start buying. It's a nice price for us. If they buy $5 billion worth of right here and then they sell $5 billion worth of, well, not $5 billion, but whatever they bought, well, they made 30% money on their trade. So if Coinbase buys $5 million of Bitcoin right here and sells the same amount right there, they made like $1.7 billion. And they did nothing. All they did was manipulate price lower, right? All they did was manipulate price lower to take out all these stops, right? And they collect fees on liquidity. That's all it is, guys. It's very simple. I apologize for rambling, but I really want to get it through your head. Liquidity is the number one most important thing. Without liquidity, you don't know which direction it's going in, right? If you don't know where they're targeting or where they're coming from, which liquidity pool, then you're lost. You're going to get lost, you're going to get chopped up, and you're going to lose money. All right. So I hope you guys enjoyed. Once again, if you need a trading platform, Hyperliquid is the one I use. Obviously, I'm not logged in, so obviously it says nothing. I have no money in here because I'm not logged in. Likewise, Axiom and all that. So once again, I hope you guys enjoyed. Hopefully this video wasn't too crazy for you guys. And once again, thank you for all the support. I love you all, and I'll talk to you soon. Peace.